Hello, hello.
Good afternoon, distinguished colleagues. My name is Tobena Erojikwe, and I'm the chairman of the governing board of the Institute of Continuing Legal Education of the MBA. It is my pleasure this afternoon to welcome you to the second edition of our training on taxation law. I'm particularly grateful to the faculty of the MBA ICLE responsible for training on taxation law for the industry and the resourcefulness that they have brought to this task. I'm also grateful, especially because they are not paid any honorarium. They are doing this completely pro bono for the benefits of members of the association. So we're very grateful. I thank Dr. Judo Dinkonibo, the Dean of Faculty, and also Mr. Steve Arubike, who also is one of the coordinators, and both of them are here. Today, our topic is taxation of non-resident entities in Nigeria, and the speaker for today is none other than Professor Abiola Sani, Senior Advocate of Nigeria. He's the managing partner of ASCO LP. He is one of the leading taxation law practitioners in Nigeria, and I don't think that he needs too much introduction. As a matter of housekeeping and house rules, I'll just say that at halftime, when he's done presenting his paper, Mr. Olatunji Moritola will do question time, and then we take things from there. Now to the introduction of Professor Abiola Sani. Abiola Sani is a senior advocate of Nigeria and a professor of commercial law in the University of Lagos, UNILAG, with a specialization in arbitration, taxation, and commercial law and practice. He started his teaching career in Obafemi Awolowo University in 1991 and transferred his service to UNILAG in 1999. In 2003, he won the prestigious Fulbright Fellowship and completed a 10-month fellowship in the International Tax Program of the Beasley School of Law, Temple University, Philadelphia, USA, where he was also appointed a research fellow of the Institute of International Law and Policy. Sani acquired his doctorate degree in commercial law, taxation, from the University of Lagos in 2010 and was appointed an associate professor in 2013. In 2016, he had the singular honor of being simultaneously appointed as Professor of Commercial Law and occupier of the professorial chair endowed by Lagos State in the University of Lagos for the advancement of taxation and fiscal matters. This has interestingly earned him the sobriquet of a double professor, perhaps the first in UNILAG, especially in recent times. He's the editor of Introduction to Nigerian Legal Methods, popularly known as the Blue Bible, in Nigerian universities and other countries in the West African sub-region. He's also the author of the Introduction to Nigerian Business Law, the founder and editor-in-chief of the Nigerian Revenue Law Reports, NRLR, and African Tax Law Reports, the first law reports on tax cases in Nigeria and Africa, respectively. He's the coordinator of the Tax Club, a vibrant student advocacy group, a trustee and president of the Tax Academician Association of Nigeria, a corporate platform for teachers of taxation in faculties of law, departments of accounting, and economics in tertiary institutions in Nigeria. Sani is a thought leader and thoroughbred professional with a multidisciplinary background. He's a member of the Nigerian Bar Association, International Bar Association, a fellow of the Chartered Institute of Taxation of Nigeria, a fellow of the Nigerian Institute of Chartered Arbitrators, and a life member of the Nigerian Society of International Law. Since 2011, he has been involved in international arbitration under the International Chamber of Commerce and the United Nations Commission on the International Trade Law on Sectoral Rules, and a member of domestic arbitration and a number of domestic arbitration. He's also a resource person for the Fellowship Training Program of NICAB. He has served the federal government of Nigeria in different capacities as a professional. He's a member of the Tax Advisory Committee, TAC, think tank group for the Federal Inland Revenue Service. He served as the chairman of the National Tax Policy Review Committee in 2016. Contrary to the infamous tradition where reports of committees are subtly discarded, he was appointed the chairman of National Tax Policy Implementation Committee in 2017 to implement the key recommendations of the revised national tax policy. He has been a member of the Federal Government Fiscal Reform Committee and Tax Advisory Committee, which is responsible for incubating annual Finance Act since 2019. I don't think that you could have a more interesting profile for a speaker on the topic for today. So it is my pleasure, my honor to introduce Professor Abiola Sani, Senior Advocate of Nigeria. Prof, the floor is yours.
Yeah, thank you very much, Tobina, the chairman of the governing board of MBA, Institute of Continuous Legal Education, and also the dean of the institute for the honor of having me at this auspicious occasion. Let me add a little footnote to my resume. I'm a professor of commercial law in the Department of Commercial and Industrial Law, University of Lagos, and that is my main address. So in order not to get into trouble with my employer, it's important we underscore that as part of my responsibility in engagement of the public and also public service. So having said that, I have a PowerPoint presentation which I would like to share, and then I will need 1 or 2 minutes because for inexplicable reason, it's failing to download. So if I have 1 or 2 minutes, I will quickly sort that out. Then you'll see the PowerPoint presentation on the screen. So with the permission of the chairman of the governing board and the dean, do I have the 2 minutes, please?
Please take the 2 minutes, Prof.
All right, thank you. Yeah.
Hello, please. I'm just maybe two people to bear with us. Prof is trying to sort out his PowerPoint. We hope he will be back soon. Thank you.
It has just refused to download. Yeah. Maybe I should
Okay,
just speak to
you,
it.
you can just present
from
it like that, Prof. Then
it has
later
just,
you will.
it has just refused to download, you know,
Okay.
but I reckon it to be more interactive if I could display the screen and then participants can follow.
Prof, is it possible to send the slides to me?
Okay, yeah. Let me send it
to me.
Yes.
Yeah, then whilst you're presenting, we'll try and have it loaded from the back end.
Okay,
Yeah.
all right. So Tobena, I've sent it to your WhatsApp and I've also sent it to the group WhatsApp.
Thank you. We'll work
So
on
you
it
can
then.
pick it from there, yes.
Thank you, sir.
So while you project it, let me just begin the presentation in order not to further waste the time of participants. I most sincerely apologize for this delay on account of technical glitch on my part. I plead for your understanding because this is something I've never experienced. You know, I don't understand why this will just not download on my system, whereas it could download on the system of my colleagues. So I will be speaking to this exciting topic, taxation of non-resident companies in Nigeria. So it's a privilege to be here. The overview of the presentation is as follows. After the introduction, I'll deal with what I call conceptual clarification and also the scope of the presentation, followed by taxation of Nigerian companies. Because before we can understand or put in perspective how non-resident companies are taxed, we need we need a snapshot of how Nigerian companies are taxed so that we can spot the differences and the similarities, if any. Then I will now focus on the legal framework for taxation of the non-resident companies, because it's important for us as lawyers to be very clear what the legal provisions are. And once we batch all the legal provisions together, an average lawyer will be home and dry, because the provisions are in English and we can make sense of it. And where we have difficulties, we can consult either literature or decided cases. And where all this may also not fully illuminate the issue, we can also seek help. So
Sorry,
we'll look
Prof,
at
the slides are on. Sorry, Prof.
Okay, all right.
Slides are on. All right, thanks.
Thank you so much. Yeah. Equity does nothing in vain. Thank you for your intervention. So can you go to the next slide on overview? Okay, so I'm going to focus on the provision on Companies Income Tax Act. Then we will look at the aspect relating to withholding tax. Then we come to VAT. After that, I will speak to case laws and then issues arising. So by the time we have all this, any average lawyer should no longer be in any difficulty on how to navigate this issue in case he or she is confronted with it in practice. Next slide on introduction, please. Introduction, please. Okay. So why not do as a slide presentation mode so that this could be bigger? So let me start. There are emerging opportunities for lawyers in the taxation space. So I like to commend the ICLE for seeking to position lawyers for the opportunities ahead. Because in some other climes, taxation is dominated. And I'm using that word intentionally or consciously. The leaders of thought in the tax space in other climes are lawyers, albeit lawyers with bias for also some multidisciplinary studies, including accounting and economics. So, but lawyers are always in the forefront. And I'm happy that ICLE is leading in this regard in order to encourage more lawyers to be interested in the subject of taxation. So I see this more or less as a refresher course for tax lawyers or those who have background in taxation. Because if you look at the array of topics, you will see that this goes beyond taxation 101. So it's like a deep dive into some contemporary issues of taxation so that people can really understand what is happening and also join the conversation and also be participants in that space. So focus of this presentation is on the legal framework for non-resident companies in Nigeria. So for example, if you receive an advisory as a lawyer or as a law firm on the tax treatment of a non-resident company, how are you going to approach it? Where do you turn to? Are you going to be calling Jude, or you are going to be calling some other tax lawyer, Professor Abdurazak, or other people for help? Then we'll also look at decided cases, fleshing up the legal framework, and then recent developments. Then we highlight some issues, then we'll conclude and make recommendations. So the objective of the presentations are for us to have conceptual clarification on what is a non-resident company, and also to distinguish it from other related terms. That is important so that you can see how I have approached this subject. Because depending on the level of understanding of taxation by the participants, and also depending on your interest, there are so many things you may expect this introductory paper to cover. But by the time I finish with the conceptual clarification, it will be clear why certain things have been included and why certain things have been omitted. Then you need to understand, participants need to understand the policy. What is the overriding policy behind the framework? Why is it structured that way? Why are we even trying to tax them at all? Or why are we not taxing them enough? Then we look at the legal framework. As a matter of fact, I'm batching all of them together so that you know you have a panoramic view of all the provisions that are relevant. Then we will focus on CIT and VAT. Those are the two broad consumption taxes that I have decided to focus on. But if there is a question on other aspects during the Q&A, I'll be happy to provide answer. Then what are the key issues arising from the perspective of rights and liability? This will play out when we are looking at decided cases. Then how did the framework evolve? In the discussion of the decided cases, as much as possible, I've tried to treat the cases in a sequential order so that you can see how they evolve, how the law evolved to the present stage. So, conceptual clarification. I simply define a non-resident company as a foreign company. Foreign company in the sense that it was registered, formed or incorporated under the law of another country. So it's a non-Nigerian. It's a non-Nigerian corporate entity. Some definition will define it with a bias for a particular type of tax. By going further to say that that does not carry on business in Nigeria. But we are going to see that that definition can defeat actually or be inconsistent with the framework that we are going to see very shortly. So being a foreign company, ordinarily it has no obligation to have a physical presence in Nigeria. Just like a typical Nigerian company, there is no obligation for a Nigerian company to have physical presence in other countries. For countries like Britain, where branch offices are allowed under their law, you know, a Nigerian company could operate in Britain through a branch without necessarily registering a local entity. So as a rule, a foreign company has no obligation whatsoever to have a physical presence in Nigeria. So there is no violation of any law. And of course, we know that our section 54 of CAMA, which has been reproduced in the CAMA 2020, obligates a foreign company that desires to do business in Nigeria to open a Nigerian entity. So the question are, why should a non-resident company be liable to tax in Nigeria? Then in what circumstances should a non-resident company be liable in the first instance? Even when we provide that they are liable, what are the administrative constraints for the non-resident companies and also for the tax authority? There are some non-resident companies that do not even know about all the laws we are going to start discussing this afternoon. They are not aware. So the few that are compliant are the ones who have nexus with Nigeria, either because they have a local entity or because they have consultants advising them as soon as there is breaking news in the fiscal space. Okay? So how can these challenges be surmounted? Okay? So we need to bear all this in mind as we go deeper, so that you can understand why the law is framed or structured the way it is. So out of scope, you know, I've decided in this presentation to take out taxation of digital economy. Why? Because there is a substantive paper on that. And I don't want to steal the thunder of the presenter, okay? Because taxation of digital economy conflicts with issues around non-resident companies, because most of these giant tech companies have a business model where they, as a matter of policy, do not want to be physically present in their market jurisdictions. So that's the model that works. Zoom is doing this. Zoom is raising income across Nigeria at the moment. It is doubtful whether it has an office in Nigeria. As a matter of fact, it is a successful company because it doesn't necessarily have to. And it was designed deliberately so. Okay? So the issues of digital economy will be treated by another presenter at the relevant time. So I've also decided to take out the issue of transfer pricing, because transfer pricing operates only in the context of a particular tax. And it's a substantive issue on its own. So there is a whole lot of regulations that are relevant. And if we go into that, certainly we cannot do justice to this within 2 hours, even if there will not be any question and answer. And I've also refrained from going headlong into international taxation and then double taxation issue. We deal with that in a whole semester in our university at the LLM level. So unless issues crop up during question and answer, I do not want to burden this presentation with issues around international taxation, inbound, outbound, and all that. In some other clients, we have specialists in some of these sub-areas. There are lawyers abroad who will deal only with taxation issues relating to inbound. I mean, investment coming into his or her jurisdiction. And there are also some lawyers that will deal only with issues relating to taxation that are outbound related. You know, investment abroad, exports, and all that. So my prayer is that our tax system will develop to that level someday, where when you come to me, I can say, well, in my first life in this profession, I used to do it, but I no longer do it. Then you should go to so person. Is somebody saying amen or hallelujah? You know, because unless our economy grows and develops where people take taxation issues seriously, you know, we are not going to have many people, I mean, despite their passion, following up on these issues after a seminar like this. So for majority, they'll just listen to it and know that anytime an issue crops up, they can always pick the material and run with it. But if the economy is good and buoyant, as I know it will someday, you know, as an optimist, then people, the space will be so crowded that we need to separate the boys from the men. So there are people whose focus will be only on transfer pricing. Some 7-8 years ago, or thereabout, I was at a conference in Ghana, and I met a friend who is from South Africa, who then gave me his card, and I saw transfer pricing specialist. That was about the time that transfer pricing was just emerging in Nigeria. So I brought him to Nigeria, and we did some stuff together. So I look forward to a day where some of us can also move to that plane and say, it's only this or nothing. So I moved to general basis of liability to taxation. And here, you can go to the next slide, please. Here, what we are doing, what we want to examine basically is, in what circumstances will a company or even a person, because a company is also a person, be liable to tax at all? So the first thing we need to note is taxation is an attribute of sovereignty. So government is saying, because of certain overriding policy, you must pay money to me in certain circumstances compulsorily. And for a company to do, for a country to do that, the company must actually be in charge. The company must, the country must be in a position to exert its power. So, but to what extent can a country exert its power on a company or an entity that does not have nexus with it? Look at the news sometimes 2 years ago over the issue of Twitter ban. Why government actually banned Twitter? But the truth was that people were still using Twitter because there were people whose businesses and whose survival actually depended on Twitter. So some people had to resort to some technological innovation to overcome that challenge. And then, why there is no formal rollback of that policy, I think right now, even government is using Twitter. Since President Trump popularized that medium as a formal or informal means of communication of government news. Okay, so the first basis is derivation. So, and that is in short, source. So if profits or an activity derives from a particular country, then a country has a basis for imposing tax on that profit. And the rationale is government has been a silent partner in making that money. If there is no framework for that business activity, there is no way it can be made in the first instance. And nobody can question the rationale for taxation of income or profit based on source. And I don't know any country in the world, including the low tax or the non-tax jurisdiction. So they may tax it at a lower rate or shift their focus to a particular type of tax. Because if you can exercise 100% sovereign power over something, it will not be rational to let go the taxing power. But however, for overriding policy, which may be due to some other considerations, there could be exceptions, even of income deriving from a source. Okay. Then the second one is when there is a nexus with that jurisdiction, when there is a linkage with that jurisdiction, that linkage could be on the basis of residence, it could be on the basis of nationality, it could be on the basis of domicile. Okay? So, and the basis is similar to the very first one. So, because if you are a resident of the country, you are enjoying the facilities, there are externalities from the activities of the taxpayer, which the government is responsible for. So, because of that, government will feel entitled to a bite of the cherry. Then nationality. Of course, there are some countries, and my prayer is that Nigeria will also go to that level, where once you are a national of a country, you carry it with pride, you know, and then the country also reciprocates by being your guardian angel wherever you may be. So may we never witness scary scenes where people will go on Okada, carry hundreds of our children in school, and use Okada to face a particular direction, and then we are not able to do anything other than negotiate. So nationality of Nigeria should count for more, and then those who are domiciled. The concept of domicile is not well developed in Nigeria, but basically the bottom line is the intention to go back to one's place of origin. You know, if you may be resident somewhere, but you are still domiciled where you are born, if your intention is one day to go back to where you come from. So, but that is not relevant in the context of our law. Then the next one is remittance, irrespective of where profit or income is derived. Once it is remitted into Nigeria, once it is brought into Nigeria, then there is a basis for taxing it. And the rationale is that, oh, the income had already mixed, had been brought into the economy stream of Nigeria. And you know, the economists have a way of measuring GDP and all that. And so government can actually exert a pound of flesh, in quotes, on such income. So against all this background, we must bear in mind the principle of territoriality. Principle of territoriality that, look, a country cannot go beyond its geographical territory in order to exert its fiscal power. So the rule is that a country will not enforce the revenue law of another country. But that is an old law established in the case of Boucher and Lawson, which was reinforced or applied in the case of Government of India and Taylor. So when you look at all this, you see that it creates the impression that a country is an island. But in reality, especially today's contemporary world, this is not so. One, because government adopts a combination of all these approaches. Why? Against the background that there are different types and sources of income. So one approach may fit a particular types of income. It may not fit the other one. For example, withholding tax. Withholding tax is an aspect of companies' income tax. So if you want to approach withholding tax on the basis of some of these principles, of course, the money is the money derives from Nigeria, so it will come in. So what about a non-resident company overseas supplying technical professional services the law firms in the magic circle doing business in Nigeria and earning money in Nigeria, how do you tax them? They may not have ever stepped into the Nigerian soil and all that. So government adopts a combination of all this and also enter into bilateral and multilateral agreements while securing their gates from base erosion of their taxes. So what they do is, what each country does is to just have a combination of approaches to this issue. Okay, and you are going to see that combination play out in the provisions of our law. So now let's quickly go to the legal framework. The legal framework under CETA begins with section 9. Okay, section 9.1. Section 9.1. Okay, which highlights the type and the sources of profits. So sources of profit could be from trade or business. It could be from rent. It could be from dividends, interest, royalty, charges, discounts, and annuities. Okay, it could be from fees, allowances, dues, and all that. It could also arise from disposal of government securities. Because of the favorable treatment of profit from shares in Nigeria, a lot of foreign companies come, some institutional investors come, and then invest, and then they are able to take out their money without CGT. Okay, so now, I now quickly come to taxation of Nigerian company under CETA. And most of the issues are here. Okay, so Nigerian companies are liable to CIT. I'm talking about Nigerian company now. The Dangotes of this world, GT of this world, Nigerian flour mills, they are liable to CIT on their global or worldwide income. And this you will find in section 9.1 and section 13.1. Why the duplication? Okay. So section 9.1 provides that profit of any company, not just only Nigerian company, is liable to tax if it accrues in, derived from, brought into, or received in Nigeria. So any company whatsoever whose profit accrues in, derived from, brought into, or received in Nigeria. So that's the language of section 9.1 of CETA. So, but there is a potential leak or leakage where, for example, a foreign company fails to remit income earned outside Nigeria into its jurisdiction. And this played out in the case of Karam and the Commissioner for Income Tax. So in that case, the appellant derived income from Nigeria and kept the money in Nigeria. So the taxing authority in Accra raised assessment with respect to that money, and then was able to demonstrate that because there is no remission to Nigeria, and that money did not accrue in Nigeria, was not derived from Nigeria, and has not been received in Ghana, and has not been brought into Ghana. So because of that, there is no tax liability. So on that basis, the court held that there was no liability to tax in Accra. So because of the potential that Nigerian companies can actually earn income abroad and keep the money abroad. So because of that, there was an amendment of the Nigerian tax law in order to also overreach that type of income. So, but in case of a Nigerian company, in a Nigerian company, we have physical presence, and that is a registered office. You know, under the requirement of CAMA for registration, there must be a physical office. Okay, there must be a physical office. And it will also have an address. So there must be a physical office, there must be an address. So they have obligation to self-assess, and they are also subject to regular audits. Okay, so they have obligation to file returns, self-assess, then the tax authority could always go to them. But we do not have this under the with regards to the non-resident companies. So now I focus on taxation of non-resident companies under CETA. So here we also have that same section 9.1. In addition, we have section 13.3A to D. We also have section 30. Okay, and there are some innovations, some developments under the Finance Act 2019, 2020, 2021, and 2023. Okay, so now, what I've done under this particular slide is to batch all the relevant provisions. Then we also have companies income tax significant economic presence order of the year 2020. Then we have a recent circular by the FRS on this. Then under CETA, apart from provision of section 9.1 and section 13.2A to D, we also have section 78 and section 81 to section 81 of CETA. And this covers the withholding tax aspect. Okay, withholding tax is not a separate tax. It's just an aspect of companies' income tax relating to investment income. And the whole idea is, oh, okay, because income tax is chargeable on preceding year basis, in order to help the cash flow of government doesn't want to wait till next year, and then the withholding tax exists to impose tax on current year basis on rent, dividend, interest, and all that. So there is a general power vested in the minister to prescribe other forms of transactions that will be liable to withholding tax. And government has done this. Please, can you go to the next slide? Okay, so what you see on the slides relates to other types of payments apart from dividends, apart from rent, apart from interest that will also be subject to withholding tax, and the rates are provided in the column opposite the types of payments. Okay, So now we have Section 30. Section 30 of CETA that vests power in the FRS to charge tax on turnover basis. Why? Because unlike the Nigerian company with nexus in Nigeria, with offices in Nigeria, where they can visit them, where they can check their books, you know. So Section 30, which also applies with equal force to some Nigerian companies, you know, but is likely used in respect of non-resident companies, basically empowers the tax authority to tax on turnover basis where in their opinion, you know, the profit declared is less than what the company ought to have declared, or what companies that are similarly situated are declaring. So this gives the tax authority the power to impose tax on the basis of turnover. And what they normally do in practice is to adopt 6% as a fair percentage, okay? And then apply what they do in practice is they assume that 80% of the turnover will go for deductibles, all those long list of allowances, deductions, reliefs, which have to be batched out before they arrive at chargeable income, to which the tax rate of 30% is now applied. So they assume under this Section 30 that, look, okay, we give you 80% of your turnover. So we only apply 30% to your remaining 20%, which gives 6%. You know, it's so simple, it's so straightforward. So in some countries, they have argued that, look, well, that it's even better for companies to adopt simple approach such as this to taxation of everybody. So instead of asking for all manners of documents and seeking justification for all types of transactions, it is better, you know, it is better to just have a simple tax system, simple one-digit tax system, whereby tax is imposed on a straight line basis. So this is what is called flat tax. Okay? In Dr. Phillips' tax study group of 2003, this proposal was made, and then that committee recommended with evidence that if we also adopt this, it's like saying, look, because people do not actually understand how this thing is done, it's complex except for those who have deep pocket to hire consultants, or those whose investment or profile or whatever is huge enough to justify such expenditure. Majority actually do not understand how some of these things work. And they demonstrated it and showed that if we actually go that route, we will generate more money. Okay, so my expectation is that someday we may actually consider a simple tax system such as that. So, but there are always issues relating to the adoption of this simple system, because there are companies, there are some some non-resident companies that will say that, look, our exposure cannot be near 6% if we actually present our financials, our audited account and all that. Some may even argue that they are in losses, especially the Nigerian companies. So in order to obviate the application or invocation of minimum tax provision, and say, look, we shouldn't be liable to tax at all because our bottom line is in negative. So there are issues around that, and we will see that when we come to review of decided cases. So let me quickly come to value-added tax before we now come to report decided cases. As we know, VAT is a tax on supply of goods and services at the rate of 7.5%. So there's an obligation on taxable persons. Taxable persons are persons rendering services or supplying goods to others, okay? Whether distributors or retailers. And then this obligation must be discharged within 6 months, failing which, within 6 months of commencement of business. But we have section 10.2, which obligates non-resident company to also register by using the address of persons with whom they have a business relations for the purpose of registration, and also to include VAT in their invoices. Okay, so initially, before 2019, the requirement under this act was that, look, companies that are carrying on business in Nigeria should register for VAT through the means that I've already explained. But issues came up on the meaning of carrying on business. And there are jurisprudence on that, even by the Supreme Court of Nigeria. And a lot of people have argued that, look, what they have done or what they are doing actually did not amount to carrying on business. So, and then the argument is that, look, because they are not carrying on business, it's not every presence or every nexus in a foreign jurisdiction that will amount to carrying on business. Okay, so, and this you'll see in the case of Cytec International Estate Limited and Deconsa and all that. So from time to time, the issues have arisen on whether certain companies should be liable to tax. And one of the issues that demonstrated it, especially under VAT, was the case of Gazprom. Gazprom raised the issue whether Gazprom has presence in Nigeria. And I think there is a finding in that decision that there is a presence, but it wasn't unequivocally stated in that case. You know, Gazprom was supplying bandwidth to Nigeria. So I don't know how bandwidth can be supplied in Nigeria without presence. But the argument of Gazprom was that, look, they had no presence in Nigeria and they were not engaged in business in Nigeria. And then the tax authority held otherwise. And the TAT affirmed the position of the tax authority. And then there was a further decision in the case of Vodacom, whereby a similar issues arose, and then Vodacom established that, look, the foreign company was liable. Okay, in the case of Gazprom, there was the TAT held that there was no liability. But in the case of Vodacom, which was also similar, the decision was that, look, you cannot do business in Nigeria, earn income in Nigeria, and then be able to avoid payment of taxation in Nigeria. So this issue gave rise to some concerns which the Finance Act now tried to address by defining through subsequent amendment, time of supply, place of supply, in order to remove any ambiguity. So if you look at section 13(2), together with section 9(2), section 9(1), you will see that it will be difficult for a non-resident company to make money in Nigeria and then escape payment of tax. There are decided cases where attempt has been made to avoid payment of tax by subcontracting contracts, one in Nigeria to a local entity. And then the Nigerian courts have established that, look, that is too simplistic. Once the source of that income is Nigeria, you cannot avoid payments by just asking your agents to do it. And quickly, to some cases under CETA, one of the issues that usually arise is that, excuse me, let me quickly charge my laptop. One of the cases that usually come up in practice is the prevalent approach whereby a non-resident company will get contracts in Nigeria and register a Nigerian entity. So the issue of whether they have a fixed base in Nigeria does not even arise because there is a fixed base. Because the model of such companies actually require that there is somebody on ground to do certain works. So what they usually do is to split the contract into two and then make one dollar denominated. And I hope our law will no longer condone some of these things, but there may be commercial basis for them, because if some of these things will be sourced in dollars, and so there could be a component whereby there will be dollar denominated segment, which will be attributed to the non-resident company, and then the Naira components attributed to the Nigerian company. So the issue now is whether in taxing the non-resident company, accounts will be had of the portion given to the Nigerian company. The prevailing approach in Nigeria is that, look, there is no segmentation, that account will be had of the entire, including the portion that was allocated to the Nigerian company. There have been arguments on whether or not this will amount to double taxation, you know. So companies have been able to get away with this. For example, in the case of TSKJ, the very first one, they were able to do it in such a way that they were not able to escape. But in the subsequent cases, maybe because this contract was not a tripartite one, they were separate. And so the argument is that, look, you cannot actually treat a separate company as an appendage of the other. So these are some of the areas where Finance Act had tried to bring clarity in such a way that you know, the revenue of Nigeria is not shortchanged. The coordinator, how many more time do I still have, please?
Thank you. Have about 30 minutes more so that we can move to the Q&A session.
Yeah, he could stop at, he can stop now if he has finished what he wanted to present, or maybe then take up the 30 minutes you just said about.
Basically, what I will do in the slide that I will send is to treat all these cases in sequential order, you know, from the first to the last. Okay?
Okay, but Prof,
whoever is getting this will have a package of how the cases under CETA evolved, how the cases under VAT evolved, and then the current position, you know. So I can stop here and then take questions and then attempt to answer them. So thank you very much. Yeah.
Thank you, Prof. Thank you so much.
All right, Prof. Thank you very much for the very enlightening presentation. It was quite riveting. So we have a couple of questions in the comment section, so I'll just run through them. Mr. Max Nkongbe has referenced the case of Cytec Estates versus Edicomsa, where the Supreme Court held that contracts by unincorporated foreign companies are illegal contracts. So his question is, what impact does this decision have on tax obligations of non-resident companies?
Okay, now, if you look at what I said initially, I said in some countries, they actually allow non-registration of entities, foreign entities, in form of branches. But in Nigeria, that provision says there must be a Nigerian entity, and it has been replicated, I think, in Section 78 of CAMA. Okay, 2020. As far as taxation is concerned, there is no morality about types of income and source of income. So there is no blood money in taxation. So even if you have violated some laws, you have made money through smuggling or whatever, and it is not known to the tax authority, they are going to collect the tax that is due on the transaction. So as far as the law stands, you know, the tax authority will pursue all manners of profits. And in the days where technologies are leveraged, you know, technology is also neutral to all these issues, all these nuances. So I believe that it really doesn't matter. Okay.
Thank you, Prof. So Uchechi has requested that you repeat the circumstances where a company will be liable to tax.
I should do what?
That you should repeat the circumstances where a company will be liable to tax.
It depends on what type of tax. You see, let me start from the easiest, which is the VAT. Ordinarily, a non-resident company has no business, you know, registering for anything in Nigeria as far as taxation is concerned, because that just opens them up to so many issues. You know, even an ordinary individual or employees at some level may not have anything to do with the tax system. And that's why they enter into contract on the basis of net of taxes. But our tax law says, even when you are not in Nigeria, register for VAT in Nigeria using the address of the person you are dealing with, and then put VAT on your invoice. You know, that already presumes that they have knowledge of all these laws. So a foreign company that has not interacted with the Nigerian law, we have no way of complying. So there is a reverse charge on the company dealing with such a company. So the obligation is not so much, in my view, on the foreign company. Rather, it's like marking up the cost for the local company. Because whether or not the foreign company is aware, the local company, the Nigerian company is the one that bears the obligation. Remember, the sovereign power does not reach or touch the non-resident. So it is the company dealing with the non-residents that are usually vulnerable. And then they usually get this in the course of checking their books during tax audits. That is when they will say, oh, there is an outflow to this company. And then, so relating to non-residents, you know, so there is a liability once there is a supply to Nigeria. But honestly, we are just increasing the cost of doing business because it is not that guy, that non-resident company that will bear it ultimately, but the Nigerian entity over who Nigeria has plenary power. Then I quickly go to CETA. You see, number one, let's start from section 9(1). So if a company, if the profit of a non-resident company derives from, brought into, or received in Nigeria, those four circumstances, there is no escape. Okay? Now, section 13(2)(a) to E now goes to highlight what proportion of the profits will be liable to tax. And it begins by saying, oh, if the company has a fixed base in Nigeria, to the extent of the profit attributable to the fixed base. So in the scenario that I gave about splitting contracts, so if all the Nigerian company did has been earmarked, and usually it will be made to be very small, you know, and then the one by the non-resident is very, very huge. So now, whatever the foreign company makes in Nigeria through its alliance or its relationship with the foreign company and with the Nigerian company will be deemed to have arisen in Nigeria. And that is the basis of the FRS and the law saying that it's the 100%, whether you split it or not. Then also, relating to companies that have dependent agents. A dependent agent is you have somebody in Nigeria, an entity in Nigeria that does your bidding. That entity doesn't work for any other person except you, you know? So it's like the directing will of the non-resident in Nigeria takes decision, concludes contracts, and all that. So the non-resident company will also be liable to the extent that the profit is attributable to the activities through the dependent agent. Then if it's a single contract that involves delivery, you know, there are some companies that have never been to Nigeria, but maybe because of certain projects, they have opportunity to come, and all they are coming to do is just to install certain things or just to deliver certain things, some high-tech equipment and all that. The entire company, the entire profit will be liable to tax. And some of the recent developments relating to the taxation of digital economy. If a company has a significant economic presence in Nigeria, so such a company that may be involved in streaming, recording, and also maybe broadcasting will be liable to tax to the extent that they make more than 25 million from Nigeria. So basically, these are the broad circumstances, but they will be fleshed up when you complement them with some cases. And the way the cases play out is always this. You know, a non-resident company will claim or allege that it is not liable to tax. And then the tax authority will argue otherwise and say, well, these are the facts. I currently handled a matter where there is a withholding tax exposure. And then because of some complex structure, and then the company is saying that look, they are not liable to tax. So in the course of adoption of our written address, we said, look, my lord, don't let us be confused by the complexity of what they have done. You know, this is the bottom line. You know, there is a payment in Nigeria for these services. And the tax authority have been able to trace this money to this source. And their argument is that they are not liable to tax in Nigeria. And I could see the eye of the judge glowing. Oh, is it as simple as that? And I said, yes, it is. So there were all sorts of artificial transaction, all sorts of other contraption that just mystified or complicated a simple matter. And the last option is, this is not, this relates to power more or less in my own analysis. If the tax authority looks at a transaction and comes to the conclusion that, or forms the opinion that it is artificial, like the kind of case I was talking about now. And so, you want to supply this to this, A and B. A is in Nigeria, B is in, you first of all register another entity in an offshore jurisdiction that we now do it in a way that it appears as if that thing is not coming from Nigeria, it's coming from outside. So in that situation, also under Section 13(2), the tax authority can disregard such transactions and then do the necessary adjustment. So these are the basis of liability of non-resident companies in Nigeria under CIT and under VAT that I consider very, very paramount in this discourse.
Thank you very much, Prof, for the detailed explanation. So someone is asking, is the rate of withholding tax not different for companies and individuals, partnerships, business names?
That is from somebody who expects us to discuss tax 101. But in any case, let us go there. You know, withholding tax rates for companies, for law firms like ours, is 5%. Okay? But for companies, it is 10%. Okay? So if for non-resident company from a jurisdiction where we have DTA, DTA is double taxation agreements or double taxation convention. So you have a reduction in the rate of tax to 7.5%. But like I said, this will come under international taxation and not solely under taxation of non-residents. So if a Nigerian company is also involved in a transaction with another company and has suffered tax in that other country, you know, the DTA is a mechanism to not to avoid payment of tax, because like you have seen in my analysis on the conceptual part, no country will forgo the tax that should ordinarily be due to it. But in recognition that, oh, the burden may be too much, if we all exert our full rights, they may limit or reduce the exercise of their taxing power. So basically 10 for companies and then 5 for business name, then 7.5 for companies where there is a DTA.
Thank you, Prof. Then another question from the same person: for freelancers resident in Nigeria, but earning from gigs done for foreign companies / individuals, does it mean the freelancer gets tax deductible for remittance to the foreign authority and to the Nigerian authority?
Can you take that question again, Tunji?
Okay, so the person says for freelancers registered in resident in Nigeria, but earning from gigs done for foreign companies and individuals, does it mean the freelancer gets tax deductible for remittance to the foreign authority, then in brackets, derivation basis, and to the Nigerian authority, remittance basis?
Okay, if you freelance, I guess you are speaking to those who work on a permanent basis with some of these foreign companies, but they do some stuff for them. So ordinarily, because they are residents in Nigeria, they are not liable to pay tax on their income to the foreign company. Rather, their primary obligation is to the country where they are resident. So they are under obligation to disclose their income in their return. Return is an official document where a taxpayer makes a declaration of all the income from all sources and then does his computation and pay tax on it. So such a freelancer is subject to Nigerian tax law, but because his income derives from another country. Now, let me ask you, Tunji, do you think that country would be happy and say, oh, this guy lives in Nigeria, he doesn't enjoy anything in our country? We then let the entire income leave their jurisdiction without taxing it? The answer is no. Because the source is, so it's, the withholding tax will apply to such income. It may be higher or it may be lower than our own rate. But what that means is that it will be the final tax. So that freelancer is not going to be exposed to the further burden of having to disclose his income in that country. He cannot be held responsible for any tax in that country, and he has no obligation whatsoever to the tax authority of the country. So rather, those who have obligation in respect of the money they pay to him will be the payer, who can be held and who can be held accountable by the tax authority of the foreign country. Then if he's now declaring his income in Nigeria, so if the Nigerian tax authority is now saying pay 24% on your income above certain threshold, he can now say, look, I've already suffered tax of this amount in the foreign country. Then depending on whether we have DTA with that country, then there could be a tax relief in order to mitigate against double taxation. But this is very rare in Nigeria because most of these freelancers are outside the tax net. Then until we have a tax system that is able to follow all the digital footprints and bring everybody within the net, some of these freelancers, we feel that they have no obligation to the Nigerian tax authority.
Thank you, Prof. Professor Bankole Shodipo, SAN, has asked,
I'm going to charge for that one. There is no way I'm going to give opinion to my learned brother's sake free of charge. So don't worry, I will answer, then I will send my bill afterwards.
All right, Prof. So the question is the power of the Minister of Finance to extend withholding tax to other forms of payments constitutional? Can the National Assembly delegate this power to the executive?
Thank you. That's a tough question. Now, and that is coming against the background of many cases, not one, not two, where the exercise of power of the Minister of Finance relating to taxation have been declared ultra vires. I've always felt that, look, there is not something incongruous about this. Because if you look at Section 59 of the Constitution, taxation is a legislative matter. There must be a bill before the National Assembly, and there's a place where that bill must originate from. It can't originate from the Senate. It must be from the House of Rep. And this is against the background of no taxation without representation. So, but we have not had any categorical declaration on that, but it's arguable. It's something I would even like to argue and then knock the tax authority into the consciousness of doing it right. So there are so many things we are not doing right in the tax space, and this may be one of them. And let me say this, and I think this must be one of the worries of Professor Sodipo, Senior Advocate of Nigeria. The scope of withholding tax in Nigeria is unwieldy. Okay? And this is how withholding tax system evolved. With regards to income tax, which is on preceding year basis, that means my income for this year will not be taxed until next year. Under our law, 31st of March next year. But because of the realization that a non-resident person may not be within the jurisdiction at that time, so the law says when you are paying him, withhold this amount, remit it to the tax authority, it constitutes a final tax. And remember, under the territorial principle, once it's out of your jurisdiction, you can't actually pursue him. So they have extended that provision to investment income, such as dividends, you know, royalty, interest, and all that. So, but in Nigeria, we have gone beyond that to trading income. And that is why we have businesses who are saying that, look, the amount you have withheld from my income is more than my tax exposure. And now that government is saying, especially through the presidency, that we will not tax the seed, we will rather tax the fruits. We will not tax investment, rather we will tax return on investment. I believe these are some of the things we need to review. The scope of withholding tax is too wide. You know, there is no point subjecting everything to withholding tax, because you can always trace the income, you can always go to them, can always audit their books. Government may say that we want our money early. A businessman will also argue that it's also important for his cash flow. So I believe these are some of the areas where there may be some shifts, depending on the vibes we are getting from the presidency on creating enabling environment.
Thank you, Prof. John Etodo has asked, can a non-resident company be
Prof, can I give perspective on the answers that you gave regarding the learned essence?
Yo, please, you can butt in. This is not, please feel free to.
Oh, okay, I think maybe if you divide that, if you take that answer or divide it into three, that may help the learned essence. Like you rightly said, regarding non-resident income, there is actually a constitutional problem. In fact, that constitutional problem is even apparent in CETA, because CETA says that withholding tax on foreign income is a final tax. So if you have to impose any withholding tax on income of a non-resident, it is in fact a tax. So the question now is, can a minister actually impose that tax? And I think, like you rightly answer the question, the answer is no. The minister has no power. Consider some of these value-added tax issues, the value-added tax amendment order, and cases decided regarding the power of the minister to introduce taxes and levies and act. The court categorically stated that the minister has no power to impose such tax, even if there is a power under the legislation. That power is authored by the constitutional power of the House of Assembly. The House cannot, the National Assembly rather, cannot delegate its power to the minister to impose taxes. But when it comes to withholding tax extended to resident companies, because withholding tax is not a final tax, so we cannot really say there's a tax, because of course, if a company suffered the withholding tax deduction on its income in the course of the year, at the end of the year, it will still take credit for those withholding. So on that basis, there's actually no, the withholding tax is not actually, is not a tax, a separate tax from that perspective. So there's no tax for resident companies. But for non-resident companies, the withholding tax regulation has in fact created taxes imposed on those companies on their income that they earn in Nigeria. And so long as it is not in line with the legislation, that is the Companies Income Tax Act, it is also valid and it is void. But for the companies resident in countries that have double taxation treaties with Nigeria, in fact, the minister cannot even expand that, cannot extend the withholding tax to those companies, because those companies are only subject to tax under the relevant DTAs, as you rightly stated. And of course, you didn't treat the DTA aspect because of time. So you can for those companies, that's companies that are resident in countries that have DTAs with Nigeria, you cannot tax outside the provision of that DTA. In fact, CETA even made it. CETA made the provision of the DTA to prevail over the company's income tax. So you have to look at the DTA. So long as there is no provision in the DTA imposing such withholding tax, the minister has no power to extend withholding tax to companies incorporated in countries that has double taxation agreement with Nigeria. So that's the three perspective I would like to look at that question.
Okay, Stephen, thank you very much. But if you look at it, there is a clear legislative provision for taxation relating to rent, for withholding tax on rent.
Yes.
That's in section 79, dividend section 80, interest section 78.
Yes.
You see, what Prof was concerned about is the exercise of the power by the minister via section 81, that then expanded the scope to commission consultancy. For example, there is no law that says lawyers, law firms should suffer tax at 5%, whatever. It's in the regulation. Because you see, ideally, when they want to know whether Stephen has paid or not, they should follow Stephen and say, where is your return? And that will be when the tax is due. But by regulation, they have extended withholding tax to our fees. This has no proper legislative backing. It has been made.
No, if you get my answer correctly, once you solve ordinarily, this is how it's supposed to work. If my income has proper deduction, I'm supposed to get a tax credit from the authorities.
That's not even the question he asked. The question he asks is, look, why should a minister expound the scope of withholding tax beyond the traditional investment income that we know and we agree are suitable? Now every form of construction contract, will be liable to withholding tax. And I think that's his concern. And I'm saying that, look, it's clearly wrong. It's clearly wrong. And then I believe that where there might even be need for a public interest litigation in this regard. So let's keep it very simple. Basically, the focus here is, without a legislative framework of stipulation specific for commission, consultancy fee, technical fee, management fee, director's fee, and all that, why should a minister now say, begin to withhold 10 for companies and 5 for So because the tendency now is for them to just expand withholding tax to everything. And then the tax authority will now become an armchair tax authority and say, you guys collect. And remember, it exposes the payer to lots of obligations.
I agree.
Lots
Anyway,
of penalties, lots of interest. And as a matter of fact, a lot of them have said, look, we will give you the details of the people we paid to.
Go and collect
Go
from them.
after them. Why are you worrying us? Why are you troubling us? So
Yeah,
my
Prof,
answer remains, and I don't know what your own answer is. My answer remains, so when I serve my bill of charges on Professor Shodipo, you can also serve him with your own. You know, my answer is that it is no. And if Prof wants to pursue it, we can provide support for that. Thank you.
well, Prof, if I may provide, I just want to provide an alternative argument to the position you have taken. Well, the point is that the tax laws, either the CETA or PITA, empowers either the FIRS or the state tax authorities to collect company income tax in the case of FIRS, personal income tax in the case of state tax authorities, right? Now, the same law allows these tax authorities to withhold tax. And that withholding tax is not a form of taxation, but an advance payment of tax. So because at the end of the day, after the taxes have been withheld and withholding tax credit note is given to you, you'll still file your returns. And when you file your returns, either as a corporation, either as a company or as an individual, you have to show that these are taxes I've paid in advance. So, and because of the informality, the informal economy in Nigeria, the informal economy means that there are a larger percentage of our economy are not actually in the tax net. So there are people who do things, and to get them to report or pay their tax is very difficult. So that's why the tax authorities are trying to get as much as they can. So if you are earning income, either as a corporation, either as a company, as an individual, and tax authorities say, okay, this regulation, which we promulgated based on the provisions of CETA or PITA. So for individuals, the state tax authority can also collect withholding tax from individuals, maybe as a person, you're not a company, and that's where you normally pay the 5%. Then for companies, 10%. So at the end of the day, the question will be the reconciliation.
Yeah.
At the end of the day, when the company will file your income tax, for the people I'm talking about, resident company this time around, we understand that withholding tax on non-resident company is final. It's final, subject to whether the taxpayer is resident in a country that has DTT, double tax treaty in Nigeria. And if they are double tax treaty, under the hierarchy of laws, of course, a treaty ranks higher than a local legislation. So in any case, FIRS or the state tax authority could argue, yes, the money that's been paid to you, and we said, we need 5% from you as an individual, or we need 10% from you as a corporate as a company, that you're actually making a payment of your income tax in advance. So at the end of the day, you have to come to us, file your income tax. But as you're filing your income tax, all you need to do is to demand the tax credit note from us. And in which case, those taxes you've paid in advance will be deducted. So, but to extend that to non-resident company, that's the problem. Withholding tax definitely on non-resident company is the final payment, subject to the provision of DTT. If the person is coming from the company, an individual is coming from a treaty state. So if you are residing in a country that has tax treaty with Nigeria, what we're going to use to determine how much you're going to pay, whatever is the tax treaty provision.
Yeah,
Thank you,
Doctor,
Prof.
you that share,
My prof.
I share your
Please
position.
let me respond to what you said, please.
Well, Prof is the chairman here. He's the
Let me
guy. We all
respond to
listen to
what you
him.
said. You
We're
know,
just trying to contribute.
you have
Professor
two
Sani,
lawyers. You have two
Professor
lawyers.
Sani you have the mic, and I mean, you're the boss.
Now I want to respond. So
Okay,
now
sir.
you have 2 lawyers and you have 3 opinions. So we will never be able to resolve whether this is the right answer, but let's look at the basis of our argument. Now, you have done a rationalization for the status quo, but Professor Bankole Sodipo, senior advocate on Nigeria, is saying, look, it raises constitutional issue. So you don't rationalize constitutional issue by statutory provisions, okay? Or by administrative, even administrative provisions. We are talking about provision in a subsidiary law. To deal with that, they should simply.
I'm sorry,
Simply,
Prof. I'm sorry, Prof.
No, let me land. Let me land. You see, what they have done via the minister's power could have been given a proper statutory framework. If they have done that, all these issues will not arise. And this is not the only instance. You know, it's now prevalent because of the attitude or approach to shortcuts. Now that I'm going to the legislation to get the proper amendment, especially these days that you have Annual Finance Act, they still resort to some practices whereby the minister will make some amendment through regulation. And you have seen, even Stephen mentioned instances where the minister has been reversed. You know, so the issue is, withholding tax is not unique to Nigeria, but its application is unique because it is now extending to virtually everything, such that there are cases where people will come and say, look, you have actually withheld much more from my income than what I'm liable to pay. And what it means is that you are taxing my capital. You are eroding my capital base. You are taxing the seed rather than the fruits. And it's something that is very serious. So I maintain the position is that those who are comfortable with it can endure it. But those who are proactive and who want to test it have a basis to do so. So that is my
Prof, let me clear myself. Well, it appears you misunderstood me anyway. The issue coming from the constitutional part, which I didn't argue. The constitutional issue is that, of course, the power that the minister is exercising is a delegated power. From the tax, if you go to the SITA or go to PITA, the minister or the is empowered to impose, withhold certain income tax through withholding tax. And that withholding tax, as I said earlier, is actually an income tax, either for corporations or for individuals. Withholding tax is not any form of taxation. It is the National Assembly that enacted SITA or enacted PITA, in quote, because I know that most of these legislations were promulgated during the military regime, and they became part of our law under the existing law clause, section 215 of the Constitution. So the issue is when a minister is promulgating a regulation that is outside those provisions within the SITA or PITA, that's what the problem is. I'm not justifying everything they are doing. And again, for the Finance Act itself,
that's what the question related to.
No, I understand
that's what this question related to. No, there's no issue with all the things you have said.
No, I have no problem with if any regulation is going outside.
So if you disagree with me, you should make the basis very clear, because all the things you are saying now,
the point
they are not contrary to my position. Yeah. So should the minister extend
that you were against? I understand you as being against
withholding tax beyond what is in the law. She has no such power. He has no such power. That's my position.
So the question now is, yes, if it is outside the provisions of the Act, either the SITA or PITA, that's fine. Then you can make the argument. But not when you as a lawyer, you're receiving a payment And maybe the tax authority at the state level say, I'm going to withhold 5% from your money.
If it
You
is
can't say
rent,
you won't pay
if
that.
it is dividends, if it is interest,
No,
you know,
no, those ones, those ones are different.
every other one
I'm
is
talking
dividend.
about, I'm talking about the income, right? Income tax, income you are earning. So I'm not justifying everything now. Tax
I've
authorities
said
are
my
doing.
last word on it. So,
Thank you.
Professor Shodiko, you can take his view or mine. So when I send my view, if you find his view more favorable, in fact, there is no way you can avoid paying. So because you are likely to find this very helpful.
All right, thank you very much. It's been an
So don't let us
interesting
argue further.
discussion. Yes,
We can
we
engage.
have
Yeah.
We have just about 40 minutes to the end of the session, so it would be good to take some further questions. So, Prof, somebody said
there is Titi Fowokon in the audience who has raised her hands. She is somebody who has so much to offer, and I don't know whether my learned brother Silk Chuka is also on the call. This kind of conversation should not be complete without their input. So Titilayo Fowokon has been raising her hands.
Titilayo, please, you can proceed to make your comments. I don't think she's available. So I think in the interim, we can proceed with the other questions. So somebody said, I think during your presentation, you had alluded to the fact that it will be difficult for non-resident companies to avoid tax in Nigeria. So the question is, how do you identify these non-resident companies if they are not registered or incorporated in Nigeria?
Okay, thank you. Remember, I spent a bit of time trying to show that or demonstrate that, look, if somebody is not within your country, you know, your ability to do anything to him may be difficult, you know? So, but once there is a nexus and you can hold them responsible through the person they are dealing with. And relating to VAT, I said, look, we are just deceiving ourselves that we are taxing a non-resident company. The person we are actually taxing is the person within our jurisdiction. Because we are telling the non-resident company and saying that if you want to supply to Nigeria, add 7.5. So if the person is charging 100, it means he will now do an invoice 100 plus 7.5. It means the cost of that goods or services has increased by 7.5. So usually in practice, I'm saying this based on practical knowledge. The only footprint the tax authority can get is when they audit companies, especially the big ones, and then see that there is an outflow to non-resident company. And that is why it usually takes a while before they even discover. So this transaction would have happened maybe out of omission or commission. Tax is not remitted. They will now come back and raise additional assessment with interest and liability, with interest and penalty. So that is so many hands up. So many hands up.
Prof,
I hope
there is one interesting question I saw here, and I want you to answer that. So the question says, can I disagree? Can I disagree with the notion that the federal government has a right to tax profits? The government has contributed nothing towards its accumulation. For example, I own a company that I provide all the necessary inputs, including power. You say the government is a silent partner. By law, a partner contributes to the business. The principle that you cannot build something on nothing should be paramount. So, Prof, can you comment on this?
Is that, that question is from who?
From Charles Williams.
Okay, now, Charles, you see, that's a fanciful argument.
Morality.
You know, to say that, oh, I'm responsible for everything. Government doesn't do anything. There is an extent to which it can go. Government may not be doing as much as it should do. Government may be failing and flopping in different regards. But it is not true to say that you have done everything by virtue of the strength in your own hands and your intellect alone. For example, government must be regulating the business where you have made this money. When you want to fly, you are flying through the Nigerian airports. Even the currency of transaction is being regulated. So that argument should fly through the window. You know, you may generate your power by yourself. The tax law will give you, you know, deduction, will give you a relief for that. It's not commendable, but there's a way to deal with that. I've been at a forum whereby one of the leaders of thought in MBA said, oh, we have 3 generators in our offices in the 3 geopolitical zones. So tell me, why should I pay? I said, look, if there is a charge of tax evasion and you say exactly what you have said, they are going to take you straight to the gallows, to the prison, because you have just admitted that you have evaded tax. So the irresponsibility of government, even the corruption of government, may affect tax morale, tax culture, but it's not an excuse for non-payment of tax. And it's also not true that, oh, government has not contributed anything. Can a lawyer make such an argument? The certificate that you are using to practice, does it bear your name? So what we should do is engage government and be part of it to make it work better.
Thank you, Prof. So Mr. Ayo Olorunfemi, SAN, is asking, can you please expatiate on taxation of non-resident companies under Section 14 of CETA, particularly in respect of freight tax, who bears the liability?
In respect of what?
Freight tax, FREIGHT, freight tax.
You see, Section 14 deals with senior advocates wanting free legal advice. It's not going to work. You want me to explain one of the most complex part of the tax law. You know, this deals with taxation of companies in aviation, in shipping, in telecom and all that. You see, the bottom line is, whether they are Nigerian companies or non-resident, you know, only the portion of their operations that are attributable to Nigeria will be liable to tax. Let's use British Airways, or let's use Emirates. They fly all over the world. You cannot say you want to tax them on the basis of their global income. No. How many passengers did they get from Nigeria? How many goods did they actually take on board in Nigeria? And there are parameters for that, but it's difficult to actually implement it. So what happens in practice is that they are subject to a flat rate of minimum of 2%. Okay? Because most of these companies will tell you that they are actually making losses. You know? So because it is impracticable for the tax authority to actually verify and then check some of their filings and then verify them, or even understand them, because some of them may not even be in the language that we speak or understand. So the line of least resistance is to say, okay, pay 2% of your turnover from Nigeria. And then there are cases where FRS wanted to tax this company on the basis of 6%. There was a notice whereby they adjusted it to 6%, wanting to bring them squarely under Section 30 CETA. And then they have gone to court to challenge it. And then they have won at the TAT, they have won at the Federal High Court. And I think the appeal is now on the way to the Court of Appeal. So it's a complex area. My learned brother said, Ayolon Femi, my in-law. So if you ask me for this opinion, because you are my in-law, I will not charge you. I hope that is fair enough. But it's not something we can really explain within this short time.
Thank you, Prof. So we have a question here. If a Nigerian company renders services in Nigeria to a non-resident company, would a non-resident company be liable to pay VAT in Nigeria?
If a Nigerian company
renders services in Nigeria to a non-resident company, will the non-resident company be liable to pay VAT in Nigeria?
You say normally when you are the one supplying, you should charge. But you know, this will now be treated as export because you are exporting your services. You know, normally there are two principles relating to VAT, destination principle and then origin principle. So if it is origin principle, you tax in the country where that transaction originates. But what you'll be doing here now is to impose your tax on somebody outside your jurisdiction, which is technically called tax exporting. You know, you are imposing a tax, somebody that is not within your jurisdiction, that is not going to enjoy any benefit from the provision of goods. Why are they? So in order to make services competitive, the best practice is to exempt exported services. And that is what we have in our tax, in our VAT. You know, all these questions that are being asked, they relate mainly to international taxation. So if people are interested in international taxation, I will encourage the chairman of the Institute of Continuous Legal Education and the dean to consider a proper paper where issues relating to these and DTA will be made and will be properly interrogated. If I've attempted to cover all this, there is no way somebody without background in taxation can actually take away much from the presentation. Only people like you and the people like we just, it will then be like a conversation between, you know.
You're correct, Prof.
I agree with you, bro.
We have 1 minute to.
So many hands up. What happened? I can see a lot of tax experts raising. I'm sure there is Mrs. Bolanle Oniyogi who will want to disagree with me. You know, she is a very strong member of the FRS team. I'm sure she must have found some of my statements discomfiting. So maybe she wants to come in. I know she will disagree with me. So maybe
can we unmute Mrs. Oniyogi from the back?
Mrs. Oniyogi, yes. You know, because the way tax authorities will see this is different from the way the taxpayer will see this. So our view on some of this issue may be different when she stops being in the workforce of FRS. You know?
Yes.
Because these are legal issues. And as a scholar, I try to approach them objectively because the students that I'm teaching, we are producing them for the tax authority. We are producing them also for taxpayers. So if they see issues only from one perspective, they would never be able to function in a real life situation.
So have we been able to unmute Mrs. Onyodi?
All right. So if I have all the questions, within about 48 hours, I will provide responses to them. Then you can share them with the participants.
All right,
Does that
Prof.
work?
Yeah, that works. We'll do that.
And the
because it's
ones
already-
that I will also attach my invoice, I will do so. So once you ask difficult questions, expect my invoice.
Bro, you can share those ones that were attracting voice to us. Share with us, please.
Okay, no problem.
All right, thank you very much, Prof. It's
All right.
past 4 o'clock already, so I'll hand over to the Dean for his closing remarks.
Apologies for the technical glitch. And honestly, I wasn't really able to complete the.
Thank you so much, Prof.
I will come back to you on that.
Thank you so much, Prof. Prof is not a new person in the Nigerian tax industry. He's our teacher. If I had attended University of Lagos, definitely I would have passed through his class. So we appreciate your very intelligent paper that you, presentation you just made. We appreciate it so much. Unfortunately, there's no time there. Of course, I appreciate the way you try to delimit it because there are several aspects of your that also you probably would have covered, but there's no time. I promise you that we're going to look into the suggestion you made on the international aspect of it. But the problem, as you rightly pointed out, is you have to understand the local tax, the way it works, the foundation first, before you start, moving into the cross-border issues and all that. So we're trying to build the foundation. And we thank you so much. And we thank the members of the NBA, those who attended this program, the learned senior advocates, professors, and all the lawyers. We're very grateful. Thank you so much. And thank you, Prof, once again. This program continues till tomorrow. The presentation will continue until the 20th of this month. So we urge everyone to just register. You're not paying anything, just register and come and listen. And that will help. Thank you so much. Thank you.
Thank you for having me. Bye-bye.
Thank you, sir.
Thank you, Prof.
Bye-bye.